Okay. So we start with bonds. So the first question in front of you is a call provision is some bond indentures allows what? So you should be knowing what is a call provision, right?
Yes, sir.
Call provisions like call option. Okay. Bond indenture is nothing but it's a document which has all the details regarding a bond. So the first question is the call provision in some bond indenture allows. So if suppose you are taking a bond and it has a call provision embedded with it. So then what does it allow you to do? So the bondholder to exchange the bond at no additional cost for some common shares. I don't think this is one of the options because they did not say it's a convertible bond, so won't go, right?
Yes, yes.
Call provision does not give you the conversion rights. Uh, Now the issuer to pay a premium in order to prevent bondholders from redeeming the bonds. How come? This is, I don't think bonds are redeemable. Okay, the issuer to pay a premium in order to prevent bondholders from, how come they can do that? It's not like that. Issuers cannot include a provision to prevent bondholders from redeeming the bond. They cannot pay some extra money for the bondholders to, wait for some time, because once the things are fixed in the agreement, they have to follow. Are you understanding?
Yes, sir.
Agreement is between the issuer and the bondholders. The bondholder to redeem the bond early by paying a call premium. No, a call provision refers to an action by bond issuer, not the bondholder. Like, see, what is this call provision? The call provision is from the bond issuer side, right?
Yes,
See what happens in the call provision. This is the issuer of the bond. This is the bondholder. Issuer of the bond has issued the bond to bondholder. Now, issuer of the bond, when issues a bond with call provision, the issuer can buy back the bond at some predetermined price. Are you understanding?
yes.
The issuer of the bond can buy back the bond from the bondholders at a predetermined price. That is what the call option has. I think you've gone through the options concept,
Yes,
right?
yes.
So the fourth option goes well with this. Bondholder to redeem the bond early by paying a call premium, not. It should be from the bond issuer side. So issuer to exercise an option to redeem the bonds. This is almost correct, right? The issuer can exercise the call option or the call provision because in the agreement they have that right to exercise the option, right? And they can buy back the bonds. By buying back the bonds at some predetermined price is nothing but paying back the money to the bondholders. Is it right or wrong?
Yes, sir.
That's what. Option number D goes for it.
Okay.
Next question. All of the following statements are correct with respect to yield curve, except that the curve will be upward sloping. So this also has been discussed, right?
Yes, sir.
So first one, see, they are asking this, this is the yield curve. Let's say the yield curve, all of the following statements are correct with respect to yield curve, except that, see, which statement is wrong they're asking. So first one, because borrowers are willing to pay higher long-term interest rates, because borrowers, the one who is borrowing is the company, right? They are willing to pay higher long-term interest rates since long-term debt reduces uncertainty about future borrowing cost. See, a yield curve that is upward sloping indicates borrowers will pay higher interest rates on long-term debt relative to short-term debt. Is it right or wrong?
Yes, sir.
The yield curve, if it is going upwards in the future, or a yield curve which is upward sloping indicates that borrowers will pay, the borrowers are nothing but the companies, will pay higher interest rates on long-term debt relative to short-term debt. So they will pay higher interest
For long-term debt.
on long-term debt than higher interest. Short-term debt, that's the reason why it is sloping upwards. It's an understood fact. So
Yes.
uh, because borrow, see, that's what all of the following statements are correct with respect to yield curve, except that the curve will be upward sloping. So this is the right statement, right?
Yeah.
Actually, with respect to question, this is wrong. Borrowers are willing to pay higher interest rates since long-term debt reduces uncertainty about future borrowing cost. That's what, this is the right statement, but they're asking us except, right?
Right.
Because investors perceive short-term investments to be less liquid and more risky. So the term structure of interest rates is the relationship between yield to maturity and time to maturity. Whatever the interest rates, the term, the short term and long term, what you see is nothing but the relationship between yield to maturity and time to maturity. Yield to maturity is nothing but till the maturity, if you hold the bond, what are you going to get? Okay.
Yes.
So yield curve that is upward sloping indicates short term interest rates are lower than long term rates. Correct?
Yes.
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 Thus, compared to long-term investment, short-term investment will be more liquid and less risky.
Yes. Right.
So, short-term investment will be more liquid
Less
and less risky. So,
risk.
this is contradicting. So, this is a wrong answer.
Yeah.
That means this matches with this. Okay.
Okay.
So, I will write a point. Yield curve that is upward sloping indicates short-term interest rates are lower than short-term interest rates. Short-term rates are like less than long-term rates for upward sloping yield curves, and that shows short term investments will be more liquid because you'll be getting money in a very short span of time, right?
Yes.
And less risky. That's what. Okay, so this is the right answer. This goes well. Next question. Conversion price they are asking. So I will give the formula to you. Let's solve this. A corporation, did you understand this one?
Yes. Yes.
A corporation issued convertible bonds with a par value of $1,000. Corporation stock is selling at $38 per share. So the par value of the bond is $1,000 and the stock is market price of the stock is $38. And the current market price of convertible bonds is 1050. This is the market price. This is the face value, market value. Okay. What is we will first see the conversion like ratio, right? So what is the conversion ratio they are giving? The conversion ratio is 25. What do you mean by this 25? One bond will be converted to 25 stocks, right?
Okay.
Understood, no?
Yes.
So there's a so formula for conversion ratio is the so I'll write the formula. Conversion ratio. One bond has to be converted, right, into stocks. So conversion ratio is equal to face value of bond divided by the conversion price. Okay. So the conversion ratio is 25, face value is $1,000 and the conversion price is how much? That is what we are supposed to find. Am I right?
Mm. Yes.
So I'll write C here. So 1,000 by 25 is equal to C. So $40. This is the answer. Okay.
Okay. I'll note it down.
Sorry.
Note it down, Professor.
Yeah, please make a note of this.
Done.
Yeah. So this is the next question. A company issued a 15-year maturity $1,000 par value bond. The coupon rate on this bond is 9%. 9% is a coupon rate is 9%, right? What do you mean by coupon rate? The agreed interest rate. Okay. And the coupon is paid every 6 months. Investor who purchased the bond expects to earn a 12% nominal rate of return. So whoever is the investor who has purchased the bond, They are expecting to earn 12% nominal rate of return. That is what this is market rate. Okay. Hello.
Okay. Yes.
So similar kind of bonds are giving 12%. The cash proceeds received by company from the investor totaled. So how much will the company will receive from the investor, they are asking. So they are asking the present value of future cash flows. They're asking the bond price. What are they asking?
Bond price.
So first what we'll do is we'll calculate the interest amount and also the maturity amount, present value of that. So shall we do this?
Yes, sir.
So first of all, this is $1,000. 9% of $1,000 is $90, right? But they are paying the coupon semi-annually. So semi-annual coupon will be $45. Is it right?
Yes. Right.
Yeah. So this is what we've got, and we are getting this $45 for how much period? For 15 years. And every 6 months they are paying the interest. So it will be 30 periods, right? For semi-annual, if I take
Yes.
15 years is annual,
Mm.
right? But
Yes.
coupon is paid every 6 months. So it will be 30 periods, right?
Right.
So so this we have to take the annuity concept. What is annuity concept? The annuity, just a second, Samrin, just a second. Give me a second. Give me a second. Yeah. 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 So see what happens. You have to take the annuity concept, right? Why annuity? Because $45 is the fixed payment, right?
Yes.
So $45 happens to be a fixed payment. So you have to take the present value annuity factor at the rate of 12%, because this is the expected return, right? For every investor who wants to invest right now,
Yes.
at the rate of 12% for 30 periods, right? For how
Mm.
many periods?
30 periods.
30 periods. So present value annuity factor at the rate of 12% for 30 periods, 45. I have the value. I'll put it 13.765. It gives you 619.43. Correct?
Yes.
And on maturity, like how much, the company has to redeem the par value, right? They have to redeem this money what they have borrowed from the investors.
Yes.
So 1000 into uh, for 30th period, the present value factor at the rate of 12% will be 0.174. You need to multiply this 174, and when you add this two, you'll get 793.43. That's your bond price. Okay, just make a note of this. This in long-term financial management, there was a concept of finding out the bond price. Do you remember?
Yes, sir.
Yeah.
Done, sir.
Yeah. Next question. Junk bonds are what? So, so I would directly give the answer. Securities rated at less than investment grade. Investment grade is some bond which can give you positive returns. Are you understanding? Which can give positive NPV kind of.
Okay.
Less than that is always not investment grade, very risky one. So junk bonds are examples of that. They are not worthless, they are worthy, but
Hmm.
they are very risky. Okay.
Worthless security.
No, worthless is useless. Who said? Junk bonds are good. They are highly risky ones.
Okay, okay.
They so when they are highly risky, they offer high yields, not lower yields. This is also not right. Who said it is illegal? Okay.
Okay.
So Dexterl, Burham, Lambert firm. So they were the ones. They did. They are not only the ones who have underwritten this kind of bonds. They some other there are investors who have taken those bonds. So this is not illegal, and this is the right answer. Securities rated at less than investment grade. Okay. Shall we move
Okay.
forward? Because you
Yes.
should not be putting your money into this very risky ones.
Hmm.
Yeah. So they have very high risk, they have equivalent risk to equity. So they are not the ones which are always considered by the bond by the investors of bond, right?
Hmm.
But one good thing about them is whatever the interest you get, you can claim as deduction because they are exempted interest. Like companies issue this because they can claim whatever the interest they pay, they can claim deduction for that, right?
Yes, yes.
Interest expenditure can be considered as tax deduction,
Tax
deductible
deduction.
expense.
Yeah.
Yeah. Now, shall we move forward?
Yes, sir.
Next question. Four zero coupon bonds each will pay $1,000 at maturity. The bonds mature in either 10 or 20 years and have a current price of either $300 or $500. What is the following? Which of the following bonds have the largest yield to maturity? They're asking. Again, there are four zero coupon bonds. Zero coupon bonds are such bonds which never give or pay interest.
Okay.
Okay, but you get returns on them. So the bonds mature in either 10 years or 20 years and have current price of either this or this. Which of the following bonds has largest YTM? The options.
B.
On what basis? Huh. The answer to such question is, so 4 zero coupon bonds each will pay this much. So we will take up. Actually, these bonds do not have coupon rates, right?
Yes.
So $500 is the most expensive one,
Mm.
and it is maturing in 10 years.
10 years.
So, you know, uh, you are holding it only for 10 years, right?
Yes.
And which of the following bond largest yield to maturity? So 500 bond is more expensive option, therefore it does not provide the largest yield to maturity. $500 bond is more expensive option, matures in twice time, thus the yield to maturity is much smaller. Actually, this is contrasting. Why? Because the more the time you hold this, but they are not giving any coupon, right? They are not giving any coupon. They're not coupon bonds. Zero coupon bond does not pay any interest, usually sold at deep discount. Yeah, these bonds are sold at deep discount. Okay. So a bond's yield to maturity is the ultimate rate of return of the investor. So a bond that is both inexpensive and matures as soon as possible should be purchased to increase the return. Thus, the bond with largest yield to maturity. Okay, so the option here is C. Zero coupon bond does not pay you any coupon, right?
Mm.
So this gives you only the returns, right? So you
Yes.
should be considering only those bonds which are inexpensive. What is that?
Inexpensive.
And which you hold, which are inexpensive and which mature soon.
Okay.
Who knows, if you are holding it for longer period of time, it can also default. That is possible or not?
Possible.
So inexpensive and soon maturing bonds to be considered. So that is this option.
C.
Okay.
Yes.
Shall we move forward?
Yes, sir.
Next question. This you have to give the answer. From an investor's viewpoint, the least risky type of bond in which to invest is in dash.
Secured bonds.
Very good. Secured ones are the ones least risky
Least
ones.
risky. Okay.
But why not? Why not income deep discount bond? These are zero coupon bonds, right?
Yes.
These are sold very much lesser than the face value. Okay.
Mm.
They are asking least risky. Why will someone want a bond very less, like sold very less than the face value? I don't say there is no, like there is risk everywhere. Okay, the only ones where the risk can be least is the secured.
Yes.
Who knows this is a asset backed security or not? The zero coupon bond, they did not say about, they did not say that this has some asset backup, right?
Yeah.
Income bonds are dependent on earnings.
Mm. Right.
Secured bonds have security backup. Debenture bonds are, they are just like secured by the credit worthiness of the investor, of the issuer, of issuer. Okay,
Oh.
credit worthiness of issuer. But secured bond has asset backup. What is that?
Asset.
Is it right?
Yes, sir.
Here you are seeing the company's credit
Yes.
worthiness and you are investing. Like Tata company, which has very good reputation. But at times, who knows, a very big company can also default.
Yeah.
Right? Next question. If the term structure of interest rates has an inverted slope, see, it is like the upward sloping, right? It has, this is inverted slope,
Mm.
correct or wrong? See,
Okay.
if it is going upward, it is upward sloping. We know that long term interest rates will be high in this. 2 minutes, huh? Something, there's some puja, 2 minutes.
Okay.
Hello, yeah, hello, hello. Samrin, can you hear me? Hello, hello.
Yes, sir.
Yeah, yeah. So what is that? See, if the long term structure, if the term structure of interest rates have an inverted slope, we already discussed that long term interest rates will be high, right?
Yeah.
As the time for a very long period of time, and will be, short term will be more liquid, less risky, right?
Yes. Yes.
So if the term structure of interest rates has an inverted slope, what does this imply about long term interest rates compared to short term interest rates? Long term rates are lower than short term
Short
rates.
term rates
Lower than or higher than?
lower than.
Why?
Short term interest rates are downward sloping.
Short term interest rates are usually lower than long term rates. Usually. Okay, the
Okay.
yield curve is usually an upward sloping. See, let me tell you, short term interest rates are usually less than long term interest rates. But that is in the case of upward sloping. But in downward sloping, reverse. Long term
Okay.
rates will be less than
Yeah.
short term rates. Are you
Yes.
understanding?
Yes, sir.
Okay, when it's
Okay.
downward sloping, long term rates are lower than short term rates. So for upward sloping, this one, short term rates are lower than long term rates, because in long term the rates will be high, but in inverted slope short term
Less
rates are more than
than
long
long
term
term
rates,
rates.
right?
Yes. B.
Next one, if
Then
the interest rates on newly issued bond increases due to expected inflation, which one of the following will most likely occur? This is demand supply game. Why it's demand supply game? If the interest rate on newly issued bond increases due to expected inflation, people will try to buy more and more bonds, right? Because they'll get more returns. That
okay.
will that what that will do, that will decrease the demand, increase the demand for bonds and decrease the demand for stock, right?
Yeah.
And when the demand for stocks go down, what will happen? The demand goes down, so people will be less interested to buy stocks. So the stockholders will be compelled, or they will be forced to sell this at lower prices, right? So the
Mm.
stock prices will fall. So demand for bond increases bond prices, and people want to buy more bonds. That will lead to what? Decrease in stock prices,
Supply.
correct?
Stock. Yeah.
Because of less demand. So higher interest rates on bonds will lead to an increased demand for bond investments, which subsequently decreases the demand for common stock. Also, companies will pay more in interest and will have thus have less money for dividends. Correct?
Yeah. Okay.
Because inflation is high, they have to pay more interest. They will be having less to pay for dividends.
Yeah.
So the stockholders will understand. Now they are not going to get much benefit, so they start selling it. And when sales start like that, the stock prices start falling. When supply is more, correct? When demand is more, the prices are high. When supply is more, the prices are less.
Low.
Correct or wrong?
Yes.
Now, next one. This one you have to answer. Can I say bonds
On.
secured by full faith and credit of issuing firm?
Yes.
We already discussed, right? Next.
Mm.
Next question.
December.
On December 30, finance company sold a non-interest bearing bond. Non-interest bearing bond is deep discount bond, right?
Mm.
Requiring 10 annual payments of $10,000. So the payments are to be done, fixed payments, 10 payments, and made the first payment on December 30 at the end of the year. The market interest rate for similar bonds, they are giving 8% discount factor, right, in the market. Information is given to you. They're asking you what amount should finance report as bond receivable. So you have to find out bond price. Can you do this?
Yes, sir.
See, in
Um,
this, the final payment, what should be done is not given. The face value is not given. Only they have given 10 payments of 10,000. Into, you have to take what? These are not semi-annual. These are 10 annual payment, 10 annual payments. So period 10. Acha, you have to take period 10 or period 9. You tell me. Because
first
the
of the
first payment is done at the end of the first year, right? So from there,
yes,
the next are 9 payments, correct?
mm, 9.
So you have to take 9 payments. Are you understanding what I'm saying?
Yes, sir.
Why? Because December 30 the first payment is made at the end of the first year. From there we need to take from there how many? So the present value is 10,000 on the first year end. Then we have to find out the present value for the leftover 9 payments, right? 9
Mm.
periods at the rate of 10,000. So 10,000 into 6 point. Did you understand?
25. Yes, yes, sir. Yes.
This is the answer. Okay. Present value annuity factor at the rate of 8% for 9 years or 9 periods. Shall we move forward?
Yes, sir.
Next question. Firm plans to issue mortgage bonds subject to an indenture. That's the document which has all the details. Which of the following restrictions or requirements are likely to be contained in the indenture? So what is the answer for this? Receiving the trustee's permission prior to selling the property. This will be a very valid condition. Why? Because what they do is, it's a mortgage bond, right? Asset backed security. Hello.
Yes, sir. Yes.
2 minutes, somebody, 2 minutes. Yeah, a firm plans to issue mortgage bonds subject to an indenture, right? What do you mean by mortgage bonds? It has some asset backup. That means if I want to get loan, I need to mortgage that my property with the bank, right? To get loan. Correct or wrong? Hello? Hello? Hello?
Hello. Yes, sir.
Yeah, see, if I as an individual want loan, I
Mm.
need to mortgage my property with bank, right? In the
Yeah.
same way, company wants money from people. They have to mortgage the property, right? Hello.
Yes, yes.
That is asset backed security only. What they will do is they will transfer the assets to a trust, and the trust, whenever the property has to be sold, the trust will give the permission. Without their permission, the property cannot be sold. That is a
Mm.
valid point in indenture. Correct or wrong?
Yes.
That is pledging the assets. Maintain the property in good condition. Yes, good operating
Yes.
condition. Ensuring plant and equipment certain minimum levels. Yes. Including a negative pledge clause. What do you mean by negative pledge clause?
Not using same collateral for multiple loans.
Sorry.
Not using the same property for other another loan.
Yeah, you cannot pledge the property once again. So all these are valid points in bond indenture. So what can be the option for this?
Or C.
Next question. See, yield curve questions they are giving many times, and we have discussed also right now. So you have to, do that in lot more details.
Okay.
13th question.
What should be
What
measured?
what variable is measured on vertical axis of yield curve? These are two things, right? Horizontal axis, vertical axis. What you will be seeing in vertical axis? Interest rates, right?
Mm.
This will be
Interest.
interest rates or what?
Interest rates and revenue.
Actually, it's not. It's a yield curve. So it will be showing yield on vertical axis. You will be saying yield, right? Hello.
Hello. Yes, sir.
The vertical axis shows the yield
Okay.
because it is increasing, right?
Mm.
Yield
Yes, yes.
in the long term. Yes.
Yield of demand. Okay.
Then what is on the horizontal axis?
Power.
Years to maturity. This will show the years. This will show the yield. So x-axis is horizontal axis. Horizontal axis years. Vertical axis
Yield.
yield. Next, 14th question. A requirement specified in an indenture agreement that states that a company cannot acquire or sell major assets without prior creditor approval is known as what? Very simple protective covenant. It's a loan covenant, right? It's a precondition set by the investors or bondholders that without, they cannot sell any of the major assets without
Mm.
the approval of the bondholders. Shall we
Okay.
move forward? Next one. Did you understand this one, Samreen? Hello.
Hello. Yes, sir.
Yeah, you understood the above one, right?
Yes, yes.
Next one.
The downward
A
sloping.
downward sloping yield curve depicting the term structure of interest rates implies what? We already discussed that when short-term
Uh,
rates for downward sloping curve, short-term rates are higher than the.
long term.
Yes. Next one. 16th question.
Echo on the
A curve on a graph with the rate of return on vertical axis and time on horizontal axis depicts what? Depicts what? A
in
yield curve showing the term structure of interest rates. Can I say this? You see what actually? Here you see the interest.
yield.
Here you see the yield, right? Here you
Mm.
see the
Yes.
time. So yield curve showing the term structure of interest
Okay.
rates.
Yes, yes.
Next one. What variable is measured on horizontal axis of yield curve? Very simple. You should be
Yes.
answering. We discussed.
Yield of the bond. Years to maturity.
Yeah, it is years to maturity of bonds.
Bond.
Here you can see years to maturity interest rates. Interest rates are nothing but as you move forward and on the maturity date, you get all the returns.
Yes.
What is meant
In
by
the
that is every time we are getting interest, right? That interest is again reinvested. Again, you get interest that is again reinvested. So
yes.
on maturity, what you'll be getting will be more than what the company has offered you, right? So
Yes.
that is called yield, yield to
Oh,
maturity. So interest rates. 18th question.
yield
Yield curve shown implies that the, you can see this yield curve. Long term rates are high, they will be saying. So what's the answer for this? Very simple. Long term interest rates have higher
yes.
annualized yield than short term rates. It's an
Short
upward
term.
sloping curve, right?
Yes. Yes.
Next. 19th.
Which are the points scenario would encourage short
Which of the following scenarios would encourage a company to use short term loans to retire its 10-year bonds that have 5 years until maturity? See, which of the following scenarios would encourage a company to use short term loans to retire? It's they will take the short term loans to pay their 10-year maturity bonds and still 5 years are left over.
interest rate increased.
See, we will see. Companies experiencing cash flow problems. So company increases the cash flow problem by shifting to short term loans. See, if company has a, see, they have to pay, right? Which of the following scenarios would encourage company to, would encourage. So which of the following scenarios would encourage a company to use short term loans to retire their long term bonds?
Mm,
Still 5 years maturity. So if company is experiencing cash flow problems, they can take short term loans, right?
yes.
So this can be which of the following scenarios would encourage? Yeah, this can encourage, right? But if they take short term loans, what happens? If they have to pay long term loans by taking short term loans, they're increasing their problem or decreasing their problem?
Increasing.
Increasing the problem. If you want to repay your long term loans by taking short term loans, you are increasing your issue problems, right?
Yes.
Interest rates have increased over last 5 years. So company should maintain the existing debt. Company should maintain the existing debt if prevailing interest rates are higher. See, if interest rates are increasing, why will they borrow? They have to maintain their own loan, right?
Oh,
Is it
yes.
right or wrong?
Yes, sir.
So they have to maintain their own debt what they have instead of taking new loans.
Mm,
Interest rates have declined over last 5 years. This is a good indication, right?
yes.
The interest rates have declined. Refunding with short-term debt may be appropriate in this case. The bonds pay a higher interest rate than new short-term debt. Assuming that the rates continue to fall, the short-term debt can itself be refunded with debt having a still lower interest rate charge. So if the interest rates are declining, they can take short-term loans and they can repay. Again, if they have issues, they can again take short-term loans, right?
Mm, yes.
So this will be an ideal option.
Okay.
Whenever the interest rates are going down, it's a very lucrative thing, right? You can
Mm,
immediately borrow and you can pay off. And again, when you have issues, you can again take short-term loans.
yeah.
Next.
Calculating it.
Indirectly, they are asking you to find out the bond price. So total value of the bond, this is the face value, right? This is to be paid at the maturity. 4 years
Yes.
is the maturity period.
Mm,
Discount rate is 6%. So what
percent.
we will do, they did not say anything about coupon. So 1000 into present value factor at the rate of 6% for 4 years. What it will be? 0.792. So the answer will be 792, right?
Yes.
Shall we go for the next question?
Yes.
Next question.
All
All of the following may reduce the coupon rate on a bond issued at par except a. All of the following may reduce the coupon rate on a bond issued at par except a. See, what is meant by reduction in coupon rate? Reduction in the interest rate of the reduction of agreed interest. See, all of the following may reduce the coupon rate. See, change in rating from AA to AAA. See, this is increase in ratings or decrease in ratings?
decreasing.
What? See,
It's
AAA bonds are the best ones. These are the best ones actually.
increasing.
So improved ratings.
Yes.
So an improved rating is a feature attractive to investors that may result in their acceptance to lower coupon rate. Why? See, if a bond is very, very strong and very secured, you will be adjusting yourself for lower returns, right? Why? Because when the risk decreases, the returns also should decrease, correct or
Decreasing.
wrong?
Yes.
So all of the following may reduce the coupon rate on bond issued at par except. So this we accept. This we accept, correct?
Yes.
So an improved rating is good for investors and they accept lower coupon rate. When they will not accept, we'll see. Conversion option. See, a conversion option is feature attractive investors that may result in their acceptance of lower coupon rate. So what happens if like the coupon rates are decreasing, they will like to convert their bonds into equity, correct or wrong?
Yes.
Call provision. Call provision. See, a bond issued at par may carry a lower coupon rate than similar bonds in the market. If it has some feature that makes it more attractive to investors. For example, sinking fund reduces default risk. That means company always allocate some amount in a fund to repay the bond money, and that reduces the default risk. Hence, investors may require a lower risk premium and be willing to accept a lower coupon rate. Why they will be ready to accept lower coupon rate? Because the bond is more secured, right?
Mm.
More secure bond, lower coupon rate is acceptable. Other features attractive to investors include covenants in the bond in nature that restricts risky undertakings by issuer and an option to convert the debt instruments to equity securities. So what happens? Like other attractive feature to investors would be some kind of conditions. What conditions? Covenant
Mm.
is condition, right?
Okay.
In the bond indenture itself that will restrict risky undertakings by the issuer. That means they should not be going for some risky kind of investments or risky kind of like buying. Okay.
Mm. Okay.
And an option to convert the debt instruments to equity securities. So they will be, if more risk they see, they will be happy to convert. So an improvement in a bonds rating from AA to AAA also justifies reduction in risk premium and lower coupon rate. However, a call provision. Now we are discussing about solely about call provision.
Yes.
So call provision is usually undesirable to investors. Why? Because the company will be buying the bonds at lower prices. Correct?
Yeah.
So the issuer may take advantage of a decline in interest rates to recall the bond and stop paying interest before maturity. So call provision is that they will like to buy back the bonds from investors. When the bond price decreases, what happens? The interest rate should
Increase.
increase. There's an inverse relationship, right?
Yeah.
So issuer
Yes.
may take advantage of decline in interest rates. So when the interest rates is decreasing, the bond price will increase
Increase.
automatically. But under call provision, the investor would be buying the bond at some specified
Ye-
price which will be lower than the market price. So this
Mark.
is not acceptable to the investors, because even though they have to get higher prices for the bond, the company with the help of call provision can buy the bonds at lower prices from them. Okay.
Yeah.
And that is not acceptable for them. Are you understanding? So the issuer may take advantage of a decline in interest rates. When the interest rates decrease, that will automatically increase the bond price. And call provision will be on the side of the issuer because they can buy back the bond at lower prices, which the investors does not want actually, right?
Yeah.
So here
Right.
in this case, the lower rates, the investors are not ready to accept. Are you understanding?
Yes, sir. Yes.
So they will buy back the bond and they'll stop at lower prices and they'll stop the paying the interest also to the bond holders. This is not acceptable. So all of the following may reduce coupon. See, this option, this option, this option, this option. All of the following may reduce the coupon rate of a bond. Coupon rate on a bond issued at par, except, see, all of the following may reduce the coupon rate on a bond issued at par, except. So call provision is going to reduce the coupon rate or not?
Reduce.
Yes.
No, sir. It will not reduce.
Coupon reduce the coupon. That is not going to reduce the coupon rate, right?
Yeah.
Improvement in bonds rating can, okay. So bond issued at par may carry a lower coupon rate than otherwise bonds of same kind in the market. Just a second. Yeah, here it may not reduce, but they may take the advantage of lower interest rates. So all of the following may reduce the coupon rate on bond issued at par except a call provision. Call provision is not going to reduce the interest rates, right? The change in rating is going to do. Conversion option. What about conversion option we discussed?
Um,
Conversion option is a feature attractive to investors that may result in their acceptance of lower coupon rate. Why? If the interest rates are going down, they may get the bond price may increase, and if the stocks are giving more value to them, they will like to convert or not.
yeah. Converted into equity.
Equity, yes, yes, of course. So
Yeah.
conversion option is a feature attractive to investors that may result in their acceptance of lower coupon rate. If the interest rates are going down, the bond price will increase, of course. And what will happen is the if the conversion premium is more than the bonds, so they will like to convert the bonds to equity. And like in that case, they will be wanting to take the advantage of. See what happens when the bond price is increasing. It will. No, actually, we
Decrease
discussed right now when the bond price increases, the stock price decreases, right?
market price.
No,
The
if the bond price is increasing, the demand for that means people will like to buy that the bond will become expensive. They like to go for stock. No, just see, I will discuss this question in the coming class. Let me have a clarity on this. Okay.
okay.
Next question. Only 21st question. I will give you a proper clarity on this. Serial bonds are attractive to investors because what is serial bond? They will mature serially. That means mature on different dates. Are you understanding?
Okay.
So maturity will happen one after another, one after another. Those are called serial bonds.
Okay.
So they are very much attractive to investor because investor can choose the maturity that suits their financial needs. See, serial bonds have staggered maturity. Staggered means stage wise. That is, they mature over a period series of years. Thus, investors can choose the maturity date that meets their investment needs. For example, let's say there's an investor who will have a child starting college in 16 years, can choose bonds that mature in 16 years, right?
Yeah.
So what will happen serially? The bonds will mature in 16 years. So
Yes.
they can see their financial needs and choose the maturity date. Yes.
Can
So
we add?
like can we like stop today here, Samrin?
Okay. Okay.
We have done 22 questions.
Mm.
We started with bonds, right? I think almost 43 questions are there.
Okay.
43 questions in the sense we have done 50% of this. So rest of the questions you are supposed to do something.
Okay.
There are more 21 questions. Will you solve them?
Yes, I'll try.
Because we have done 22 questions, right? So you can
Yeah.
solve 21.
21.
Yeah, next
Okay.
class we will take stock. Stock 15 questions are there. I will
Mm.
finish 10 questions in that, give 5 to you. And immediately we
Okay.
can jump for dividends also. That has 36 questions. So we can do 20 questions in this. So this section, this total PDF is done. Okay.
Okay. I'll try other 21 bonds.
Yeah, please like go to this like before solving the questions again, go do a thorough reading of this. The questions are very informative and giving you lot of things to understand. And all
Mm.
these questions, what they're asking is nothing but present value of bond everywhere. So questions
Okay.
are of similar kind only. Any doubts you can let me know. Okay. Only few
Okay.
questions are there, nothing more
Mm.
than that. Okay, Samri, then tomorrow we'll take the class for the next session. Right?
Okay. Okay, sir. Thank you.
Thank you. Thank you.